It's the last day of the month of August, so we are going to take a look at all of the companies who rose their dividend since we last looked at the end of July. So we have a pretty big list today. It's 47 companies long. We've got raises ranging from 62.68% to 0.39%. So what's important for us here is the percent of the raise. We're looking for something higher than inflation. So if it's lower than inflation, it's going to be marked in red. If it's an okay raise in yellow and a good raise is in green. And then the payout ratio to see if they can afford that dividend. We have 30 to 50% in the green. Yellow would be below 30 or just out above 50. And red would be stuff incredibly high, more like above 75. At that point, they're paying out a bit too much of their profits as dividends, unless, of course, it's structured to be that way, such as a REIT, which we have a few of those, and those are in blue. And then we have some valuations over here. So this new value is based on the current bond yield. So if it's in green, that means that you're getting a better yield than you would be getting buying a bond at this time. And as dividend investors, we definitely are focused on that yield. So that's a good metric to look at. So we'll start with just some of the top ones, some of the bottom ones, and anything to note. Green means that I really like what I'm seeing from it. The blue is a REIT, and yellow is it's okay, but like the dividend's good, but the valuation you're not getting a bond yield, which is pretty high today. So getting that is not an easy accomplishment. So Diego PLC is in first place with a raise of 62.68%, taking their dividend from 3.08 to 5.0178. And their payout ratio is 61.7%. So they bumped it up a little high. Maybe they're expecting some higher earnings this next year or over the next quarter. We'll see how that continues, but that's a really big raise. And then Westlake Corporation rose theirs 40.06 from $1.42 to $2. Their payout ratio 19.8, so they have room to continue growing that. No worries there. In fact, it's a little low for a dividend investor. Marcus Corporation came in with a huge raise, but it's not pulling in a PE ratio. So the trailing 12-month PE is most likely negative. That's what I've seen. There's another one down here when this happens. So I would not bank on that dividend raise continuing at that rate or even existing in the future. Bank 7 Corp, BSVN, with a 31.25% raise from 0.64 to 0.84, 21.6% payout ratio. So they're a little low with it. They can definitely continue with these high raises, and that's what we're seeing for a lot of these lower ones. And then this one I'm actually interested in. I'm going to have to dig deeper into it. SunCoke Energy Incorporated rose their dividend 25% from 32 cents to 40 cents for a new yield of 4.33%, 37.8% payout ratio. Perfect. And that yield is higher than the yield of a bond. So this really looks like a good dividend stock right here. I'd have to look into the actual valuation, but I'm going to put it into the dividend portfolio where we don't care about the valuation. We're just seeing if we can find companies with strong dividend growth, decent payout ratios, and ideally a little bit higher of a starting yield, and see how that performs against the value portfolio. And then another one that I'm kind of interested in is this VINP, 25% raise as well, 64 cents to 80 cents. This is a REIT. They currently have a payout ratio of 88.4%, so they're going to probably have to come in with another raise or issue more shares because they are required to pay out 90% plus of their profits as a REIT. And of course, that 7.7% yield is much higher than you'd be able to fetch with a bond, nearing almost double that. So those were some of the top raises. Some of the lower ones, we can take a look at those and see. Federal Realty Investment Trust with a 0.93% raise. It's not. It wasn't a necessary raise, but it looks like they're trying to keep up a streak. Vistra Corporation, VST. I used to own this one. I sold out of it because I didn't like what I was seeing on the value front, and it looks like on the dividend front as well, things are not the best. They got 22.4% payout ratio, but they rose it by less than 1%. So even if the Fed is able to get inflation to their 2% target, you're losing 1% to inflation. Dover Corporation, DOV, rose theirs by just shy of 1%, 28.2% payout ratio. So another one where they're just trying to keep up a streak. Oh, there's one here that just looks like a big red flag across the board. Kellogg's Company, ticker K, rose theirs 1.69%, so it doesn't even keep up with inflation, from $2.36 to $2.40, but their payout ratio is already 95.3%. So, we could look deeper into the financials and see if there was something strange going on with their earnings this last year, if there was some sort of acquisition or lawsuit charge of some sort that they had to deal with. But as it stands, trailing 12-month, they're paying out 95% of that. So the company's not really making any profit paying out a dividend like this, and it's going to have to either be cut or the company is going to decline. And then we have a whole bunch of stocks where I put them in yellow, where things look decent. Wingstop, 15.79% raise, 42.1% payout ratio, but it's only a 0.54 yield. So yield's a little low, but aside from that, it looks good. Intuit, with a 15.38% raise, 42.8% payout ratio, 0.67 yield. VRTS, 15.15% raise, 40.9% payout ratio, and 3.66% yield. So this one's looking decent. That's a decent yield. Of course, bonds are fetching a bit more than that right now. So that'd be the type of thing where if you think that there's value in it as well, it could be a decent investment. H&R Block, 10.34% raise, 34.9% payout ratio, 3.18% yield. That one's looking decent too. INGR, 9.86% raise, 36.3% payout ratio, and a 3.02 yield. SWKS, 9.68%, 41.4%, 2.49%. John Deere, this is actually their second raise of the year. So year over year, this is up more than 8%. They could definitely raise it more with a 16% payout ratio, but over time, it should get up there at this rate. 1.31% yield. So let's see who has the highest yield after these raises. Capital Southwest Corporation. Highest yield. It does not look like that dividend is safe. Altria, Second highest yield. Does not look like that dividend is safe. I sold out of Altria. I used to have it as a dividend play. I looked into the balance sheet and the financials, and I did not like what I was seeing. So I got out of it. There's too much risk to begin with to have that poor of a company. Simon Property Group. I know a lot of dividend owners, or I know a lot of dividend investors own this one. 2.7% raise. So it's a little low. It's outpacing inflation, at least. It's a REIT. They could definitely come in with a higher EPS for the year. So with a payout ratio close to 100%, they could come in the 90s. We're looking for stocks within that 30 to 50% raise, and or 30 to 50 cent, 30 to 50% payout ratio, and that would be this section here. Lots of green across the raises too. So looks like it was a pretty good month. A lot of raises overall. But let me scroll out a little bit. So if there's any stocks that we haven't touched that you might own, you can take a look at this whole list and see what's going on with them. And I'll put it in alphabetical order too. So I will pause here for a second, let you take a look, and we'll talk to you again next month when we have another set of raises. So I want to thank you guys for watching. Please like if you enjoyed the video, comment which of these stocks you own, and subscribe so you can stay up to date and see what the next dividend raises are. And I'll catch you next time.